Hey guys, welcome to the second episode of Finance Operators. I have my co-host Drew here. How are you, Drew?
I am doing fantastic. Happy to be here. How are you?
Good. What are we covering today?
We've got a lot on this docket. So basically, it's a bloodbath out there, specifically from like a public market perspective. I want to dive through a lot today. First of all, we're going to go through just like it was a big earnings week. So I want to get your take kind of on just like a general sense of sort of the landscape. And then there's two sort of case studies that are interesting in particular. One of which being Allbirds, which I've been sort of, following for a long time, and then Solo Brands with a, near 70% dive yesterday. We're recording this on Thursday the 13th. So I want to cover those things, but then I want to get into your Maytab's tactics as well. So what do we got? What do we got there?
We have the internal math for selling to PE, selling to strategic, or raising growth equity. How does it work? What drives multiples? How are you going to get more money for selling your company?
Fantastic. I love it. Okay, cool. Let's start with this earnings sort of digest. Basically, obviously, it's earnings season for 4Q24. We've seen over the last 2 weeks, there's been a lot of reports come out, and it's a lot of red. A lot of macro headwinds contributing to that, but also not particularly exciting, sort of in the consumer sector. So like, Allbirds down, UNFI down, Kohl's down big, Dollar General up. This is what I find interesting.
Dollar General is always up though. They crush it.
Yeah. So iRobot down, American Eagle down, Grove Collaborative, which acquired 8 Greens.
They finally went profitable, right?
I didn't read the report.
I think it was the first. Right, though. Yeah, it was the first adjusted profitable quarter.
So Grove flat, and they acquired 8 Greens, which I thought was an interesting print. We can talk about that in a second. But Vera Bradley down, and then Ulta trading down this morning. So you have one winner here, and the one winner is Dollar General. So you tell me what is going on here. Why are people so risk off A in general, but B in consumer, and then like what do we need to pay attention to kind of going forward to kind of give ourselves context as to what when we're operating these businesses to be offensive or defensive? Like what's like sort of your interpretation of all this?
Yeah, what it feels like is a lot of these companies just shouldn't have been public in the first place, right? They IPO'd when the market was really, really hot. And for some reason, everyone believed that the growth they saw during COVID can continue. And it obviously can't. TAM just isn't big enough to support it. I mean, the revenue levels you need for some of these companies, some of these products are just kind of crazy if you wanted to sustain the kind of valuation.
Do you think that's mostly what it is? Do you think it's a big TAM thing?
I think it's TAM. I think it's a big reason they can't grow very efficiently, right? I think investors have finally kind of realized that and realized, it's just an uphill battle from here. And it's very, very uphill. I mean, Allbirds, right? How many people want nerdy wool shoes? You can't really, if you live somewhere where it's wet, you can't really wear them, for example. I think there's obviously a level of mismanagement. There's also a level of just, it's a hard market. You're so big, you can't shrink. If you get too small, things just don't work when you're public, right? You have to pay for a lot of, there's a lot of regulatory fees, et cetera. Even delisting is expensive. When you delist, you usually get sued by shareholders. I mean, it almost always happens, and it's really expensive to deal with. Yeah, it's like delisting is not a simple process. It's probably like, you're probably going to spend 8 figures to delist.
Jeez. Yeah, I mean, that's, and not only to delist, but also just to be a public company is exceedingly expensive as well. And like that's like, part of the reason when I look at Allbirds and I'm just like, I want to take this thing private, it's because like the OpEx is really the blow in that company, right? Like it seems like it would be a lot more straightforward to kind of reduce the cost structure. There's obviously headwinds from like the brand perspective and all that, but I think like what I thought was particularly interesting was the idea that Dollar General is sort of the diamond in the rough right now. Like, is that a leading indicator of like, hey, we're going back into this, maybe like more staples type environment where, like tariffs obviously are causing inflation, or at least going to probably cause inflation. The consumer may not be as strong as we originally thought, so now they're all just going to go shop at freaking Dollar General. Like, is that what's happening here, or?
Dollar General's always crushed it. I think I'd have to go pull up a chart, but I'm pretty sure they've done a really really good job of just growing the brand fairly effectively. Right, they're kind of like the first ones to start retailing in the middle of nowhere as a
Mhm.
chain, and
It's
that's
an
where most of the
$18 billion
locations are.
company.
Yeah. They've crushed it. If you ever go to a small town, they're kind of the only big retailer there. Have you ever done that? Like you drive through rural America or something, and you stop somewhere, and there's just like a Dollar General.
Yeah, I went to college in a town of 20,000 people in southwestern Ohio. um, so I mean, I've seen them everywhere. It's interesting to me. So like, I mean, they're literally right now trading up, and I would have to dive into the details, but trading up 8%, which is not nothing for I mean, that's a huge move for a retailer, like a deca-billion-dollar retailer. Like that doesn't really happen very often. So
They're just really good at monetizing every square foot in there inventory wise. They're kind of the first ones to take. I think it was Dollar General or another dollar store. I can't remember. I'm pretty sure it was them to take things really seriously as far as how everything's merchandised and optimizing properly. They kind of like led the pack for a long time. I don't think that's the case anymore, but or it might be to an extent. But they used to be the ones that were far ahead of everyone else.
I mean, I that makes sense, like theoretically, but I feel like with these like dollar items, which I don't know that they're a dollar anymore, but like you would think that it's very cheaply made stuff coming out of China that would be subject to tariffs, which you would assume would squeeze margins that are already pretty thin, even with like the tailwind of like maybe the consumer, kind of goes more budget mode. Like what do you think is sort of the impact of like the overall, tariff situation on a company like this? Because clearly the market doesn't think that it's going to be that impactful.
Yeah, I think it'd be weird if they didn't see margin compression, right? I think what the market's mostly banking on is that they feel there's a fair bit of growth left in the company. I know they have quite a few locations, but it seems like they've been able to keep opening, keep expanding quite a bit without any issues.
Okay, so Dollar General is the only stock that's going up forever from now. Apparently, everything else is going to zero. Presumably because there's a lot more conscious consumers, and so it kind of begs the question: like we as operators, we as e-commerce merchants, as retailers, like how are we supposed to compete with a business that has that kind of scale and that kind of ability to price so low with because we talked about the gross margin spiral of death or whatever. I mean, it's so hard to like come up with a strategy that allows you to compete with literally Dollar General when the wallet's starting to feel a little bit tighter, right?
Totally. And it's not a good place to be. No one wants to be in the death spiral of offering discounts. Every e-commerce CFO knows, revenue is not just about what you bring in, it's about what you keep. And one of the biggest margin killers, discounts, right? So brands typically lose 7 to 20% of their sales to discounting. Even worse, you'll typically see codes get scraped by Honey, Retail Me Not. It all adds up. It all bleeds. Your bottom line ends up looking gross and not in a good way, the bad kind. And you know what really helps with that? Our sponsor, Fondue. Fondue is a beautiful cashback solution where you use cashback instead of discounts, which enables your marketing team to offer bigger incentives, all without taking the same financial hit as traditional coupon codes. It's really easy to install. You can quickly run a test, see for yourself if it works or not. It'll probably work. We've had a really good experience. So instead of handing out discounts that cut into profitability, cashback protects your margins, putting 2 to 5% of profit back in your pocket just from your marketing team's welcome series alone. That's tens, maybe hundreds of thousands of dollars straight to your bottom line, depending on the size of your brand. Guys like Ridge, True Classic, etc. They've already used Fondue Cashback to keep more of what they earn. So go sign up, let them know you heard about us, get that VIP treatment, and give it a test. Again, cheap and fast to test. There's no reason not to do it. It's another tool in the toolkit, something new to email about, something new to text about, something new to throw on the website, something new to run ads about. Get it done.
Okay, well, you heard it here first. Monetize every square foot that you can in large TAMs, or if you go public, your stock will be crushed. So I thought it was an interesting thing to kind of touch on because it is a bit of a bloodbath out there, and Dollar General was just this
The
little
lone
shining
survivor. Yeah.
the lone survivor, the little shining star in the
You
sea of red.
do you want to jump into Allbirds?
I do. I really am excited to talk about this one. So do you know sort of the backdrop, sort of the history of
No.
Allbirds?
Can you walk me through it? Let's start from the beginning.
Yeah, so basically like Allbirds, classic D2C darling situation, right? Like they were started by these two guys, who I believe were actually like professional rugby players or soccer players, and they were from New Zealand, at least one of them. And they basically thought that, hey, like we could use this wool to build more sustainable shoes. And so they basically launched Allbirds in 2015. The guy's name is Tom Brown and Joey Zwillinger. Those are the two founders. And they grew like, pretty nicely, pretty quickly. And so they raised their first round of funding in 2015 from Lair Hippo. So Lair Hippo is obviously like one of the most, no, at this point at least, one of the most notable sort of
OG consumer investors in a lot of D2C brands, and they've stopped. I mean, they don't touch it anymore, really.
yeah, most of those folks kind of have moved their focus to enablement. So like Lair Hippo is in the category of like, if you're familiar, like Forerunner Ventures. Like I think of like Kristen Green was like the GP at Forerunner.
Yeah, she did Dollar Shave Club, right?
Exactly that. So she kicked off the whole. I consider Kristen Green to be like the godmother of like D2C, literally, because she kicked off basically the whole race and did really well with Dollar Shave Club. Forerunner's obviously been a huge success. Lair. So basically, my point is these guys, they raised money from Lair Hippo in 2015, allegedly a $25 million valuation. So pretty healthy sort of seed round.
Yeah, I'd say it's very healthy relative to what you'd see today.
especially in 2015. I mean, this is 10 years ago now. They grow a little bit more, and then the next year they raise their Series A with about $1 million in sales. Is sort of the report. They raised $7.5 million from Maveron. So Maveron is similar category, consumer focused.
They're actually they're seeded with one of the co-founders of Starbucks money, Howard Schultz money.
Oh, I didn't know that.
Yeah, it's his money, and then I don't think he's really that involved. But yeah, that was like their kind of first source of capital, I think.
Yeah. So then by 2017, you get Tiger. So now Tiger's in the mix. Series B, $27 million.
You have to tell us why you're grinning. What's Tiger famous for? What do they do that's hilarious? What happens in 2020?
They led, I mean, every single, I would love to know the number, but they led basically every single round that you ever saw. And they just like spray and prayed like as much as possible. And I believe their fund was down like 80% or something.
Yeah. So basically the strategy was like, they tried to create an index fund by like their goal was index fund like returns by investing in basically anything they saw. They just throw everyone a term sheet for $5-10 million and they would just kind of forget about it. They did a lot of bigger rounds too, obviously, but it did not work.
It did not work. But they're also a total blue chip, like, tier one fund. So like, it was a big deal. It's a big deal to get money from Tiger. I mean, it still probably is. So they go from 1 million in sales in 2016 to 27 million in sales in 2017. This is where Tiger steps in for the Series B. It's an $18 million round. And then that valuation was 1.4 billion. That seems crazy to me. That almost can't be right.
Nobody underwrites that anymore.
Yeah. Well, so either way, so then in 2018 the valuation is 1.4 billion. So maybe shortly after Tiger comes in. These are all numbers that are reported and are not always perfect, but okay. Anyways, fast forward 2021, it's IPO time, right? Because that's the end game. So they IPO at $2.16 billion in valuation. They reached a peak market valuation of 4.4 billion. At the time, that was about 20 times their forward sales. And then that's the end of 21. That's November of 21. Almost immediately after the IPO, they pop up to 4.4 billion. And then literally 13 months later, at the close of 22, they've lost 91% of their market cap, and it's a 383 million.
What do you feel sentiment was among kind of the consumer people that investors about that stock when it IPO'd?
Yeah, I mean, so I was literally covering e-commerce from a sell side equity research perspective, and at this time, and so I quit like just a little bit before that to join Mad Rapid, but people were hot on it. Like we did the IPO for like Vroom, the company that sells cars online. We did the IPO for Corsair, which sold hardware. Like there was so much money going around that like these companies were perceived as generally very appealing with long runways.
Interesting. Yeah, because on the PE side, like whenever I talk to people, everyone was just confused. Like, oh, how'd they do that?
Yeah, I mean there's so many like giant consumer companies though that like the more that I look into it, the more I sort of understand where they were coming from. Like Lululemon's a $50 billion company. Shark Ninja, multi-billion. There are avenues for companies to get there. It's extremely hard, and we can get into that in a second. I want to finish this sort of decline. So, 2022, 13 months after the IPO, the company's lost 91% of its value, and then it's just like a slow trickle, basically to zero from there. So by 23, it's a $200 million company, and then 24 really fell off again to about 60 million. And then after their most recent print, it's just more of the same stuff. Like, their net income, technically improved year over year, but like that's because there was a huge impairment charge in the fourth quarter of last year. So, if you kind of scrub these things, like they're not making a ton of progress. Like revenue is falling.
Like what happens now? I mean, they're clearly too small to be public, right?
They're way too small to be public. I mean, they're doing $55 million a quarter at this point, which like, I mean, like there are
our friends
yeah. We have friends that are bigger than that. Yeah.
Yeah.
There's probably 4 companies on Iris that are bigger than that. Okay, so $55 million of 4Q24 revenue, that's your peak of the year too, right?
It's really not profitable, right? Like, I mean, to get to profitability, so let's just assume they're doing 200 million a year on a run rate basis. How much do you think you have to cut top line to become profitable?
I think Allbirds is a really nice $50 million a year business.
Me too. I think it's like maybe 50 to 80 million a year, depending on how well they can expand into other categories. But I don't think 200 million or anywhere close to 200 million is realistic for the product line that they have right now. Keep in mind, they were not like a discount heavy brand for a long time, and then they introduced discounting. So like the revenue you see and the efficiency in CAC is somewhat artificial, right? Didn't they just start introducing discounting, and that's why you saw a lot of the compression on margin?
Yeah, so basically the story of the P&L is essentially like, okay, we IPO in 2021, and then like we were doing really well sort of for the first quarter or two. But then that's when the markets turned. So I mean, these guys top ticked the market. Like these founders, like I'm sure they made out like bandits. They did
awesome.
a fantastic
job.
Yes, congratulations. Dump your bags on everybody else. This is why we love capitalism. So basically, like they're still growing. 4Q21 is literally the peak of their revenue at 97 million. And then it's just like a slow burn from there. So I was looking at the inventory trends, and they just started like this. They were going for it. Like they were going to go for the dream. And they stockpiled too much inventory. They were burning money. And when the stock market didn't like that anymore, it was time to sort of liquidate that stuff. And so you saw gross margin go from 56% at the peak to 31% this quarter. There's some other dynamics involved in that beyond just discounting. For example, they've pursued a distributor model for their international business, which is obviously just going to come with like, lower gross margins in general. I still think that's a very poor management decision.
Why is that? Why do you feel it's a bad idea?
Because like, why would you ever pursue a 30% gross margin as like a footwear company? Like, you're like this, like, so Skechers gross margin is 53% and OnCloud's gross margin is 48%. Like this is supposed to be one of the strengths of your business model.
How is OnCloud doing? Do you know? Have you looked at their stock?
They're crushing. They're over 10 billion in market cap right now. So basically, like, to your point about MER, like CAC, the CAC like isn't, I don't know that that's like the problem here. So for example, like MER is 4.5, for this quarter. You saw like the Chubbies print come out yesterday, and they're closer to 7. So maybe it should be closer to 7, but like fine MER as far as I'm concerned. Like the real problem is like this OpEx is 29 million. The
OpEx is insane. So we actually had two hedge funds reach out about like just seeing if there's something to do there, what we thought, etc. That was the first thing I noticed, just how insanely fat the team is. And if you go to LinkedIn, my favorite thing to do is just browse LinkedIn, take a look at the team. You can kind of figure out like what's going on there. It is just so you can tell like you need to cut like 60-70% of the team, and you can tell it's one of those companies where you go and everyone's just working part-time basically, probably working like 4 to 5 hours a day. Just gives that vibe off. You can tell no one's being held accountable for anything. And honestly, I think a lot of it is like you lose the founders and you lose really disciplined management. Well, I'm not in this case. I don't know how disciplined they were given there is a bunch of money, but there's no one there that really, really cares, right? And it's clearly reflected in the org structure. I mean, there's no way you can justify the current org structure. It doesn't work. I actually talked to a few of my friends that run 9-figure footwear brands that are bootstrapped, profitable, et cetera. I think they're around like 120, 150 million in revenue. And he was saying they run with basically, I think 3 or 4 times less people. So
yeah,
there you go.
I mean, there's going to be a little bit of like the public regulation that's involved in that, right? So like,
totally,
I would definitely expect there to be like more. Yep. But yeah, I mean, like there's 29 million. You have 52% of your revenue in 4Q24, which by the way is the peak of your revenue quarterly. In these SG&A expenses, and like I think some of the SG&A is like payment processing and sort of more cogsy stuff like that. But it's just crazy to me. So like, back to your question, like what do you think happens? I think this is like one of the best takeover targets. Like I've been saying this since it was an $80 million company. Like
how much? What does the debt side look like that they're sitting on?
Negative. They have negative net debt.
Oh, weird. Okay.
Yeah. So like you actually could get a discount to this market cap. So like whatever they're trading, like let's look at whatever they're trading at right now, because like there's, I think they have like 8 million or whatever of like positive, of like cash, over their debt. So yeah, so it's 42.8 million. I mean, you'd obviously like, there's control premiums and like market dynamics. So like, who knows like what you could actually get it for, but like, let's just say it was like 50 million. Like I would buy this thing for 50 million. I would throttle the revenue by at least half. I mean, then you would cut the whole team. You would immediately start printing money. I mean, Allbirds is still a very well-known brand. Whether or not it's en vogue is up for debate.
You could underwrite it shrinking quite aggressively, and you could underwrite the brand actually just like not existing in 5-6 years. You'd still make money on the deal.
Oh yeah. And that's why I'm okay with the revenue shrinkage that we're seeing. I'm not okay with the revenue shrinkage when everything under it is also deteriorating.
Right. Yeah, it doesn't really make any sense.
Yeah. Like have you guys ever got into a brand that was like just operating like way beyond its scale and like then pulled it down and right sized it, or like what like give me like a real world example of when that's happened?
Yeah, I think this happens a lot when companies gear up and then there's no one to kind of sit down and make the hard decisions. And you see that accumulate. Like there's been a lot of hard decisions put off over time. And because of that, there's this build up and you need a third party to come in, someone who really cares and is incentivized to care to kind of come in and cut the fat. And often there's just no performance target that they're being managed to, right? The reality is if I have a marketing team and they have a goal of like reaching a certain spend to revenue ratio, like let's say 20% and growing the company 20% or something, and they're not hitting that every single quarter, maybe there's an excuse for a few quarters in a row, maybe there's not, and maybe they're the ones that even set the target. Eventually you have to move on, right? If it's not working, you have to swap someone in. So yeah, we've had to do that a bunch. I'd say it's extremely common, even in the profitable companies that we invest in. We find sometimes there's a lot of hard decision making that's been put off. Like we invested in a profitable company in Q3, and we terminated not a crazy amount, but definitely like a handful of people that just weren't driving value. And it's by the way, that doesn't mean the founders are bad or people running it are bad. It just means no one's taken like a very critical eye to it. And the advantage we have is that we look at so many deals, right? Like I see a ton of companies, a ton of org structures. So I can tell you like what should output for the supply chain person be, et cetera. So, but true. You know what's even worse? Like, you know what would really bug me if I worked there?
Say it.
Using a really irritating ERP. And you know which ERP I actually love using and I'm very pleasantly surprised by? Our sponsor, Fulfill. I think they do a fantastic job with everything. Our integration was super smooth with them. They had us up and running in insanely quick amount of time for a very complicated operation with, we have hundreds of BOMs, the bill of materials, all that was coming in. We manufacture in-house across 2 countries and then ship to a third to get it out. and they made it all happen. They made the integration happen. They really understood what we were doing at a deep level. They helped us launch channel scripts, which are fairly complicated. We were immediately able to reduce the complexity and the kind of the grindy, irritating stuff that happens in our business, especially on the operations side. I'd say by a factor of like 4 to 5x. It was crazy. So
what's your favorite module with them?
WMS. Usually we slice up the WMS module and we're stuck using a third-party WMS because there's one ERP that everyone loves for no reason because they don't know what they're doing. And they always love, and they don't realize the WMS module in that ERP slows you down. But the one in Fulfill is really, really good and it doesn't actually slow you down. So relative to third parties, it's like probably one of the only ERPs that has a really good standalone WMS module. So we're really happy with them. They're a sponsor of the pod. Great guys. I really like them. I'd highly recommend checking them out. Let them know that you heard about them from us. And yeah.
Like you said, there's sort of two avenues. And like I just pulled up my my on-cloud comps. So just to kind of put these side by side. So on-cloud revenue, this is for the year of 24. So on-cloud revenue, 2.3 billion. Allbirds revenue, about 200 million. The growth of those revenues for on-cloud, 23% positive. Allbirds, 25% negative. So on-cloud gross margin, 60%. Allbirds, 43% for the year, but big sequential drop off in Q4. MER 8.4 for on-cloud, 4.5 for Allbirds, which I really don't think is that bad. SG&A as a percentage of revenue, mind you, it's hard to know exactly if this is apples to apples, of course. But 52% for on-cloud, 70% for the year. Is that even right? Yeah, that's right. 1Q24, 39 million for this is Allbirds, 39 million in revenue. 39.3 million in revenue, 39.7 million in SG&A.
Holy. What is the justification? I'm just like, it's just really weird. I don't get it. Even if you backed out all the compliance costs, I kind of wonder where that would land. All right. Well, that's a mess. I guess something interesting will happen. Do you want to dive into Solo at all? I think that's another really interesting one.
It's more of like the same story too, which is kind of why I wanted to cover it, right? Like just like these struggling brands in the public market that like have no business being there. Like I think do you want to talk about Solo Stove and Chubby's, or do you want to talk about the acquisitions that they made first?
Why don't we start with the story of them if you want? I know it really well.
Yeah. Tell it to me.
Yeah, so I'm fairly close to Spencer, the founder of Solo, like the actual stove company. Basically bootstrapped it with his brother. Insanely grindy guys. Like I think there's like 2 of them and they were doing all the customer service. They hated hiring people until they were doing like, I think it was 10 or 30 million. It was literally like 4 people, something ridiculous, running at insane EBITDA margin. I want to say like 30, 40%, something absolutely bonkers, growing at the kind of like, I think 2 to 4x year over year. Eventually they sell the business to Summit. Are you familiar with Summit?
Of course.
Cool. And do you want to just kind of explain to the audience what they're known for?
Summit is this might be a little bit aggressive, but kind of like the Lair Hippo of like the growth world, where they just have like they win really good deals, they write really big checks, they sell really big companies. Like so, for example, like their latest, or maybe not the latest, but their sort of latest headline deal was Dr. Squatch. So I think they valued Squatch around $2 billion or something, and they'll buy a 9-figure chunk of it and then try to flip it. More classic growthy private equity type model, but very well known firm.
Yeah, and they've done a lot of they do a lot of tech, and they've done a fair bit of consumer. So, anyways, eventually the business gets sold to Summit, and I think it might have sold to another private equity firm before that. Just Solo. This is just Solo Stove at this point.
Yeah.
And like a controlling stake, yeah. Like a controlling stake sells. Spencer and his brother still have a tiny stake, but I think they're fairly hands off by then. They'd hired a CEO, and I think it was the same CEO who was the first guy when they went public. I can't 100% remember, but apparently a great guy. So they do really well. And then I think the thesis was, let's turn this into a D2C platform. So they buy up a bunch of brands. They buy Chubby's. They buy Oru. Oru's crushing it too. I'm close with their founder just randomly. He actually gave us a lot of advice when we were moving one of our brands to Mexico. So Yeah, so they bought up all these brands, and I think they bought a handful more really niche ones after they went public. Do you remember what they were?
I mean, they bought Terraflame for 13 million, which is I actually have a Terraflame. Um, it's like a little stovetop fireplace. Yeah, it's actually it's a pretty cool idea. But then there was this guy that DM'd me on LinkedIn yesterday, who said that basically like Temu and like the TikTok just kind of like ate that market. So they paid 13 million for Terraflame. And what I want to talk about the loss on Terraflame in a second, but and then 52 million for Icy Breeze, I believe it was called, which I'd never heard of.
Yeah, I hadn't heard of it either. You know what's funny with the Terraflame thing is I feel like that's a trap a lot of people fall into on the e-commerce, or just in consumer in general, is investing in stuff that's a little bit too easy to knock off. And you can just tell it'll go. You see this all the time where a brand will come in, they'll scale insanely fast, and then it'll just implode because of knockoffs on Amazon, Temu, etc. And it happens like pretty much overnight. It's crazy. I'm kind of surprised they made that purchase. Was there a subscription component or anything like that?
I didn't subscribe, but there was like you could subscribe. So basically, it's like there's like a little fire pit, and then there's like a filler. So it's like a little bit of like a razor and blade situation. Like I'm sure they tried it.
Right. Interesting. Okay. And then so I guess how did earnings go? What happened? Where's the business at?
Oh man, it's still going. Oh Christ. Okay. So it was down 67% or so yesterday, 63% yesterday, and then a bonus 7% since then. Okay. So this is going to be a really nice conversation for you because you're so hardcore on some of the debt stuff. And I think it's an important part of the story. Essentially, my read on this is just like, Chubbies and Solo Stove actually look like fairly healthy brands. So just to give you like a quick rundown on the P&L of each of those, because they started splitting them out with this earnings report. So Chubbies, 112 million of top line, growing double digits year over year, 60% gross margins, strong, 7.7 MER, 12% of the personnel is being allocated to the Chubbies P&L. 12% of the Chubbies revenue. So that's actually, this is like a nice looking brand, honestly. Like even a margin of 14%, like you're falling right into my benchmark at least on sort of employee costs.
They've actually scaled and become much more profitable since they were acquired, by the way.
Yeah, they're still growing. Their retail business grew 21% year over year.
Yeah, that was the main driver, right? Like I think D2C was relatively flat.
3% growth. So those channels are almost equal now at about 57 million for D2C and 54 million for retail.
Cool to see.
Yeah, so it's a really nice looking brand. I think one of the accounting tricks that may be going on here is that I think 12% of revenue for employee costs, like that does look really nice. Almost like it's a little bit too nice for a company that's struggling so much, the holdco. So I wonder if we are keeping a few of the holdco employees off of that number. So some of the accountants or whatever kind of thing. Anyways, Solo Stove, different story, kind of from a growth perspective. So 351 million last year, 297 million this year. Gross margin expansion of 30 basis points, which is interesting, to 61.7% for 24. Contribution margin ratio 40%, so that's a 4.4 MER. Employee costs 4% of revenue. Another head scratcher. And so they're saying that EBITDA is 15%. And so you have these, you've got 60 million in EBITDA between these two companies. Probably the shrinkage in Solo Stove is probably more than taking over for the growth in Chubbies. So there may just be a little bit of revenue shrinkage sort of between these two year over year. Really strong gross margins out of both. So point is doing well with these two companies. As far as this report is concerned. But here's the problem. The problem is their term debt. Well, not just term debt, but they're basically like their leverage in general. And so, do you know sort of like what that situation is right now with them?
I think is it JP Morgan who's their main lender? Who is it?
Yes, that's correct.
Okay. I'm not too familiar. So what's the stack look like?
I gotta pull it up right now, but I think the total is about $1.50. So yeah, 150.7. Guess how much cash they're holding?
18 million?
12 million. Guess how much inventory they have?
I don't know. No clue.
108 million in inventory.
108 million. Okay.
And I think they're sort of writing that down pretty aggressively. So I want to get your read on how this is going to go with the lender.
Yeah, I guess maybe if we took a step back, what do you think of the holdco model in general when it comes to consumer? Obviously, like Procter and Gamble's famous. They've run it really well, profitable, etc. Why is like P&G able to make this work, and then you have stuff like this Solo where it just totally bombed out? What's going on?
These like subscale holdcos, like there's not like any like real synergies, right? So like, for example, like if you have, Chubby's and Solo Stove, like those aren't the same manufacturer. First of all, right? Second of all, they're not that big combined. I mean, you might have like a little over 400 million. Like you have like a big brand basically combined between the two of them. So I don't know that the subscale model works. I think you probably need to start out with like a pretty scaled sort of asset to be the anchor of the whole thing. And like, I work with lots of holdcos, and what sort of ends up happening is like one of the companies ends up taking off, and it's not even worth their time to focus on the other ones.
We actually used to be structured as like more of a holdco, and then we got rid of that because of the exact dynamic you mentioned. And now we basically trim, like everything's completely separate, but we'll trim positions on a regular basis and then add to them as well to pick on liquidity. But like you said, like you'll typically see one kind of take off, and it's just not worth your time to focus on the other brands. That's actually what happened to Bill at Elements, by the way. He's public about it, so I could talk about it. But his pet brand just absolutely crushed it. They do really well. Cool brand. I think it's Natural Dog Company or something like that. Chunky brand. Smart guy. I like him a lot. But he used to have a lot of other brands underneath Elements, and I think they sold those off just to focus on the pet business, which I think is the right move, right? I mean, multiples in that
Totally
are crazy.
It's the right move. It's the right move unless the one brand is taking off from 700 million to $1 billion, and you still have two other 200 million.
Yeah, exactly.
Like, yeah,
you can't really just shed them like the same way you could there.
Right.
Yeah, because you need the TAM, right? And the problem I think is the markets that these companies apply to. Well, Chubby's is different. Apparel's huge, but I mean, how many Solo Stoves can you really sell?
I mean, probably not more than $400 million worth.
Yeah, exactly.
But it's bigger than I thought it would be. So anyways, I need let me give you just a little bit more context, and then I want to hear your prediction on how this ends, because it's really hairy. So 12 million cash, 108 million inventory, $1.50 in debt.
You said Solo Stove was bigger than you thought they'd be. What was their EBITDA again?
45.9 million was their EBITDA.
I know when they were doing like 60 or 80 million a year, their EBITDA margin was above 30%. I think it was like 40%, even something disgustingly good. So their actual EBITDA has not grown much, but top line's grown a lot.
Would you rather have 60 million of revenue or 200? I mean,
no, I'd rather have the bigger asset, because I think the reason it worked before is because they were just starting out. They're kind of the only player. Now there's a lot of knockoffs. So before they had like the advantage of being the first mover, and this is before 2020, right? CAC was a lot lower. It was much easier. So
okay, let me get to this. So there's 150 million in paper. JP Morgan, I think, has it all. Some of it's I think 83 million of it is like term debt, and the rest of it's maybe revolving. Don't quote me on that. There's some covenants. So the net leverage ratio can't be more than 4, and the interest coverage ratio cannot be less than 3. And there's quarterly fluctuations in there. So my read is that they will probably breach if they haven't already. And that's why the stock dropped, right? Because the stock didn't drop 80% because the quarter was so bad. It dropped, and I want you to explain this to the audience. Like it dropped because now the debt is really stepping in and it's probably going to consume all that value. So give us a quick primer on what I meant by that, what I just said. And then I want to get your prediction on what's actually going to happen here.
Okay, great. I mean, essentially the lenders own the business, right? They can push you and they can rug pull you. And
why does the lender end up owning the business?
Yeah, I mean, at this point, I don't think Solo Stove, well, they might be able to raise some sort of debt financing. I don't know what that would look like. It'd probably look very, very toxic.
They're
or
well
difficult.
beyond that, yeah.
Yeah, I think they're kind of well beyond that. And it looks like they're not going to be able to scale top line nearly fast enough to get out of the current position they're in. Sometimes if you can scale fast enough, you deleverage essentially, right? Especially if you're public and the numbers look good, your stock price goes up. You can use that stock. You can sell stock, obviously.
You can issue it,
to pay down debt. In this case, that's not really happening. Obviously, the numbers look healthy, but they're not growing fast enough. If they're growing, like, I don't know, say double year over year or something, this wouldn't really be a problem. Obviously, they wouldn't have an issue with the covenants either. And then because of that, anyways, all this is happening. Let's say it triggers like a default or something similar with the lender. I'm not super familiar with the exact situation here. At that point, they can essentially rug pull you and they kind of have control over your destiny. They more or less like own the business is the best way to think of it.
Why does that devalue the stock exactly? Like, and talk a little bit about like how public is all common, right?
Yeah. I mean, public. If you're buying a stock, you're buying common shares, equity, and that goes to zero essentially. They eat the first loss. Lenders do not. So the value will flow through the senior lenders.
In theory, if there's $150 million in debt, let's just say that like the company can't sell for more than that, the common equity value is zero. So what do you think happens? I mean, it's JP Morgan, it's 150 million. It's not a huge position for them. There are some decent assets inside of Solo here. Where do we go from here? What happens?
I assume they get delisted or something like that. Someone sets in, takes someone kind of gets into there. Someone like, who did Casper? Do you remember? Anyways, I would imagine you have a situation like that where a PE firm known for take privates comes in and does that here, right? They take out the senior lender, refi, et cetera, with the goal of giving the business more breathing room, right? And again, these aren't bad businesses. Like, they're good businesses to own. If you sold them off individually and this wasn't if this was not a public company, you could sell some of the lower performers off individually, hold whatever is great, and then try to build a stronger platform around that. The problem here, like you said, the platform doesn't really have a theme. It's like outdoors, but I mean, Chubby's just so different from something like Solo Stove, just completely different. You can't even have the same marketers. Merchandising's totally different. Obviously, the product side's totally different, but the way the product side works is completely different at those two companies. So no synergy.
Right. So like I said, you have 60 million in EBITDA, right? And the year-over-year growth of the two companies combined is minus 10%. Chubby's is growing 11%. The weighted sort of growth rate is going to be a lot lower because Solo Stove is much bigger and is shrinking faster. So I've got, for you, I have $410 million of revenue. I have negative 10% growth rate, and I have a little over 60 million of EBITDA. Can I sell that and pay back 150 million?
I would think so. Like, I don't think it's unrealistic. Yeah, I think there's actually I guess it just depends on what. I'm a little confused why something hasn't really happened yet. It's a little bit weird. I feel like there's a lot of these consumer companies are just zombies, and there's good catalysts or reasons for them to do specific things, but they're not happening.
I totally agree. I think it's, I've been saying this kind of for a while about Allbirds, but like, it has to be this year where these things like start to get taken out or something, right? You've got a $400 million, revenue, $60 million EBITDA company, 3x EBITDA. Like, I know it's shrinking, but like it's worth more than 3x. I mean, if it's going for 3x, like I'm in line with that 150 million that's burning a hole in my pocket. My sort of overall outlook is let's look forward to some of these things actually moving over the course of 2025.
Totally. And this kind of like leads into the next point fairly nicely. We're going to cover selling your company either to PE, a strategic acquirer, or the other option is you can raise growth equity and take out secondary, which is basically just payment to you, the founder. So where do you want to start? Let's start with PE. How's that sound?
Yeah.
Okay, cool. So private equity, I think the main thing you want to know whenever you're raising money or selling your company is you want to solve backwards for whatever the goal is of the acquirer. Okay. So if I'm a private equity firm, I'm underwriting to an internal rate of return of 20%. So, and honestly, with lower middle market, so if your EBITDA is under 30, 40 million, they're probably looking more for gross internal rate of return of 25%, which means
We
they need
take
to
one
make
step back. Sorry, not to interrupt.
Yeah.
We take one step back. I thought this, when I sort of learned about this, I thought it was really helpful to contextualize everything. Before we dive into the IRR and sort of the hurdles there, like why? Like the question is why, right? Like why is the PE shop targeting 20%? And so like talk very briefly, if you can, about sort of like LP allocation and how venture capital might be like 30 plus IRR, and then private equity is sort of 20%, and then the private credit is stepped down, and that's how they think about their portfolio composition. So give me a 60-second primer on that, just so I can contextualize what you're talking about.
Essentially, private equity firm, they're referred to as the general partner. They raise money from their limited partners, and because the investment's illiquid and because it's risky, I mean, really, you're investing in relatively small companies. If you're a lower middle market private equity fund, you're not investing in massive companies with, you're not investing in Lululemon, right? So because of that, you need to be able to deliver a premium over, usually they look at like an index fund or something comparable, and that's your hurdle. And that hurdle right now, I'd say market's closer to 10%, used to be 8%. That's the hurdle rate I have to return as a minimum before I even hope to get paid anything as a GP. And that's just because otherwise my partners should just kept their money in the S&P or something, right? So the reason they need that kind of 25% gross internal rate of return nets net your LPs like 22% or 20% depending on the fee structure. But
Right.
You need to be there to deliver the premium that they want to justify the risk of going down market and even being a consumer, right? And again, I can't speak to like tech or anything like that, but typically you want that 25% gross in the lower middle market. And otherwise you're not really a marketable fund. You're not offering anything.
Right. And if I'm an LP and I have $100 million, and I'm trying to grow that, 12%, per year or whatever to meet certain obligations, I'm not gonna, give all my 100 million to one person. I am going to give, 25 million to the private equity fund that I think is going to hit 25% gross IRR. I'm going to give 50 million to some private credit fund that's only going to yield me 9% IRR, but it's way less risky. I'm going to throw 10 million into some venture fund in case it goes really berserk. And so like these investors sort of serve different purposes from like a portfolio composition perspective. So I think it's just important context to understand when you're saying, okay, like why are they underwriting this?
Yeah, and so for color, that 25% internal rate of return, that works out to being 3x in 5 years. So if I'm being purchased by a private equity fund, they need to believe that the company's enterprise value can grow 3 times in 5 years. So if you're marketing your deal, you need to think of that as far as the multiple that you're asking for, and if that's a realistic outcome, right? So most of these funds will have an investment period of kind of 2 years, then 5 years to realize the investments they make. So you really are kind of like in that 5-year clock. Usually the funds don't want to be overly involved or tactical, so you need a robust management team. That's why PE you'll see them rely a lot on historic performance. They don't like seeing up and down. The advantage there is if you're someone like us, like operators first, you can underwrite deals where there's a lot of volatility because you understand the volatility, right? Like a lot of PE firms will get spooked if they look at a brand that was D2C heavy in 2021 and they see volatility in CAC and they're like, oh, well, why'd this compress? And you explain iOS 14 and it sounds like you're really stupid, but there's actually a valid reason, right? It's a totally valid reason to, we're happy to add that back or whatever.
April 26, 2021, iOS 14.5. Worst day of my life.
Do you remember where you were?
I remember exactly where I was. I was in my office, which is at the time, and well, actually it's not anymore, but at the time it was my bedroom. And I remember like everybody, the big question was opt-in rates, right? So iOS 14.5 was its own thing. I was sitting in this exact chair.
Do you remember how bad the Facebook pop-up was for the opt-in?
Yeah, no, I think the initial, and this was a big theme on the street when I was covering Facebook, because that was part of my list, was like, what's the opt-in rate going to be? That was the big Wall Street trade. And I think whatever the stock priced in, or whatever sort of the consensus was, it got blown away by that. It was like 96% opt-in rates. And so I was sitting in this chair at this desk at a different apartment in my bedroom. And I just and this is when I was the CFO of Mad Rabbit, and I just slowly watched our sales drop by probably 50%.
Yeah, I remember our CMO at the time for one of our main portfolio companies, performance had dropped a ton. Like you said, like I want to say like 40, 50%. And I was like, what's the plan here? What's the outlook? And he goes, yeah, I think we're just screwed. I go, okay, great. So I just fired him the next week. So anyways, that's what PE needs to for them to make money. So if you're selling a company, you need to be able to get there. There's some caveats to this, which I can touch on really quickly. Most of the time, a lower middle market PE firm, they have a strategy where they want to buy 3 to 5 brands, roll them up as kind of one platform. They'll have the same theme. The guys who do a really good job of this, Digital Fuel, I like them a lot, really smart guys. They have an apparel platform. They have another platform called Renovation Brands. Smart guys, they've been in the game for a long time. They're actually very early to digital heavy consumer. They're kind of well known for putting together a few platforms. And because of that, because they have this platform, they can take advantage of multiple arbitrage. Do you want to quickly explain what that is?
It's basically like if I have, a one company that's worth 2x EBITDA, if I buy 3 companies and I put them together, then they're actually worth 4x EBITDA. And so I actually am making a spread there purely on nothing else other than the actual multiple. It's usually to do with scale.
Yeah, exactly. And the main advantage here too is the debt's way cheaper. The debt's like so inexpensive to buy the company because they're levering against a company with say, let's say you have 50 million in EBITDA at the platform level. You're getting really cheap debt and you're buying at really cheap multiples, relatively speaking. And those acquisitions are extremely accretive to EBITDA because the lender's even looking at like your total EBITDA and your ratios, et cetera. So it looks really good. It's kind of hard to mess up. People do mess it up, but it's a cool thesis. So in that case, they can afford to pay more and they almost become more of a strategic. The caveat being they're relatively disciplined on the PE side. You can't play kind of corporate politics the same way you can with a strategic. You can't light a fire under their ass the same way you can with a strategic. And we'll get into that in a second here too. But you basically want to think, can my company 3x in 5 years to deliver that IRR? If they have a platform, you can play with those numbers a little bit, but that's where you want to be. That's what you want to work backwards off of if you're looking at selling your company to private equity.
What do I need to be afraid of with private equity? Because you hear those stories.
Yeah, I could just dive into this. There's a few funds who I won't name that are famous. They'll send out LOIs, those kind of spam LOIs. And they'll be at relatively high valuations. And then they'll do what's called retrading, which is they'll just knock the valuation down very last minute.
What does it mean if I get an LOI?
It doesn't mean much, honestly. I'd say
Right.
You get an LOI, there's a 90% chance the deal won't happen. Doesn't really mean much, but people take it really seriously.
Why even send it then?
It's one of those things where the PE firm knows it doesn't mean anything, but the person who's selling their company thinks it means a lot. And usually there's some sort of lock-in that prevents you from shopping your brand around at the same time.
Exactly. The exclusivity is kind of the key.
Yeah, exactly. So we have to be wary of any sort of like backloaded compensation. There'll be like 30% of this in any deal typically, whether that's like a seller's note, earnout. We discussed it last episode, but you have to be careful that the PE firm that's making the offer, A, they can actually fund the deal because sometimes they can't. They don't actually have the money if they're an independent sponsor. And B, you want to make sure that they have a good reputation for paying their earnouts because there are a lot of funds that will purposely litigate, purposely won't pay, and they'll purposely drag that out to maximize their IRR. The reality is you don't matter to them. Yeah, like the reality is after they do the deal, you don't matter to them. What matters to them is delivering really good internal rate of return. So if they're kind of short-sighted, obviously I think it hurts their reputation. There's one fund in particular that's really well known for this. That plays kind of in the lower middle market size range. I'll get in trouble, but
no.
I'm a good guy.
You sound scared. I
I am very scared. So
I told you.
Anyways, I'll just say if it sounds really good, too good to be true, just kind of be careful. It's worth taking a discount on kind of what the net offer looks like if it means there's less structure to it and there's more kind of front compensation up front.
Okay, what about strategics?
Yeah, so strategics are where you make crazy money, right? I think my favorite example of this is something like Schmidt's Deodorant, where they took a relatively long time to get to 20 million in revenue. I want to say 10 plus years, and it was fairly slow growing. And then they were acquired for, I think, over 100 million. And that was solely driven by the acquisition of, I think Native came first, right?
You say that's where you make a lot of money. Is that? I think you can make a lot of money selling to private equity.
No, you can, but where you get the crazy multiples that make no sense, like revenue multiples, et cetera, that is almost always a strategic because they can afford to pay more. And usually they have some sort of other reason they want you. So they want you for your cash flow, but they might want you for some IP. They might want you because they feel they can plug you into their distribution really easily. Native being the best example, right? And Schmidt's is a good example too. Both those brands acquired by kind of, I think one was P&G, and then who bought the other one? Unilever? Yeah. Plugged into the distribution kind of right away after that, and they needed exposure in the space. They had to buy it, and there's only so many players you can buy, right? And we touched on this last time, but it's what you're seeing with drinks, like beverage, specifically energy drinks, right? Like with Ghost.
Yeah, those didn't go at crazy multiples. The Ghost was a 3x. The Alani Nu was a 2.8x. I've had some conversations with bankers, and I'm not disagreeing with your point. I think over the course of the last forever, what you're saying has been absolutely true. Where strategics are paying, and this is why, like, I'm going to sell my company to Unilever is like always kind of the pitch, because they do generally pay the most money. But I think if you zoom in a little bit, over the last, like, basically since 21, that narrative may be a little bit challenged, just because, like, there's so much private equity powder on the sidelines that, like, those multiples are actually coming up because they're almost forced to be doing deals. So that's sort of been a theme in some of my conversations with bankers, where people will structure these deals. You can get a better price from private equity over the last 2 years or so. So they'll do what Dr. Squatch is doing, which is clearly a two bites of the apple thing. And this is, like, clearly what's going on with Ghost as well. If you read the print, like Keurig Dr. Pepper, it's a little bit different because KDP sort of.
Do you want to explain what you mean by 2 bites of the apple?
Yeah. So basically, like, Dr. Squatch, and this is conjecture, although I'm very confident in it. I don't have any, like, inside info that I'm sort of divulging here, but they took money from Summit I don't know exactly, but I would guess maybe 50 or 60% of the company. And then what they're going to do is, like, Summit is going to restructure that team's comp so that, like, if they do really well and they execute and they sell for, however much billion in the next couple of years, they'll make more money off of that deal than they did on the initial private equity deal, right?
That's exactly what happened with Solo Stove, by the way.
Yeah, exactly. Yeah, so those 2 bites of the apples deals got really popular when the strategics just went to the sidelines in 22. So you started to see, like, there's all this dry private equity powder. They got to do something because you only are charging the fees that you actually are deploying the capital for,
right?
And so they started pushing up prices, and they started saying, "Hey, founder A, we're going to flip this thing in a couple of years." And it's like the reason that KDP didn't buy all of Ghost; they only bought 70% or whatever. Is because if they execute on it, they're happy to pay more. They're happy to make those guys rich beyond their wildest dreams if they do, what they think they'll do. Right. So it's just, two bites of the apple. And it's, you talked about secondary a little bit earlier. There's maybe some element of that, at some point too. But the structures are generally creative.
Cool. That's super helpful. And then do we want to dive into growth equity? The third option?
Yeah, hit it.
So growth equity, everyone knows that you can go out and you can raise growth equity to grow your business. I think what a lot of people don't realize, especially if they've mostly spent time on bootstrap businesses, is usually when someone raises a Series A or a Series B, at any point past that, maybe even, I'd say earlier it was kind of okay to take secondary to Series A. Now it might be more Series B. But a secondary just means that a portion of the proceeds from the equity raise go to you, the founder, to cash out. Now, the reason this is really cool is because VC valuations are materially higher than what you'd actually get if you sold the company. So because of that, you're not actually like, you can kind of retain a weird amount of control and hold a weird amount of equity after taking quite a few chips off the table.
Yeah. Usually you're taking a discount, right? Because if like, let's say like I'm raising a Series A and it's 16 million at $100 million post money valuation, so I'm selling off 16% effectively. Let's just say like half of it's secondary and half of it's primary. That primary is going to be preferred equity, which has all these preferred rights, liquidation preferences, cumulative dividends.
Do you want to explain liquidation preferences just in general, like the structure? Let's go through the structure that comes with venture. Like, what is the kind of hidden downside that a lot of people don't think through?
Yeah, I mean, we could and we should do a full episode about this, but to keep it kind of concise, effectively, the classic VC term sheet it's very boilerplate. Like, if you get anything that like isn't what I'm about to describe, it's off market, really, and either your business is sketchy for some reason to the investor, or they're just trying to see what they can get away with. So the sort of headline term is liquidation preference. That's like the first. Well, the headline term is really the valuation, but the first one that everybody kind of goes towards is that liquidation preference, which always should come in at a 1x. If it doesn't come in at a 1x, there's some other dynamics at play. But essentially, it says like, okay, like if I'm that company that 100 million post and I raise, let's just make the numbers easy, like 20 million. Let's say it's all primary in the liquidation preference. It also matters whether or not it's participating or not participating, but let's just do sort of not participating for now. If we sold the company for 20 million one day, so like we go up, we create her off a cliff, and we go down 20 million, all that money goes back to the investors, and none of it comes into my pocket as the founder holding the common stock. So we talked a little bit about the hurdle rate in like LPGP. It's very similar to that. It's basically the VC telling you, if you don't return me this amount of money, then you don't get anything, kind of a thing. It's very similar to the GP-LP dynamic.
Okay, cool. So yeah, that explains what a liquidation pref is. Typically, growth equity will come with a lot of structure, and there's some things in there that can be a little bit tricky. Sometimes I think it's relatively fair, given you're getting a fairly aggressive valuation for the brand itself. The main thing to keep in mind is,
Sorry, I was just gonna say,
go for it.
A lot of VC or growthy boys they'll give you your headline valuation. So you might say like, hey, I want my company to be worth 20, or let's say 100 million. Even if you're like not, they might just give it to you, and then they might just like have like a 3x liquidation preference, which it all kind of works out to like probably, especially if it's like participating, right? Like these guys they're freaking sharks, man, and you need to understand like this stuff, because if you don't, you will be rugged. So they play a lot of games.
It's all give and take though, right? Like, it's like, okay, you want a higher valuation, that's fine. I'll just increase liquidation prefs or whatever. So it's just give and take. I think that's the main thing to keep in mind. That's why they're solving backwards from an internal rate of return target.
Sometimes it can be a lot of take though. So like, for example, like the idea of like a cumulative dividend, like a cumulative like compounding dividend, where like if you wait, like if it goes on for too long, like all that money gets like it's financial engineering in a lot of ways. But we should do a whole entire episode.
We should.
On that, yeah.
Maybe next episode. Okay, cool. So anyways, the big thing to keep in mind is, and you can just ask a VC what this is, like, what's the terminal value that you guys are underwriting? Like, are you guys investing in brands hoping for a $500 million exit, or are you hoping for a $5 billion exit? You can go bigger. Like, food and bev is totally different. Just ignore what I said regarding 500 million. But outside of food and bev, that number is like 300 million to 500 million typically. And beauty can go bigger, but honestly, I think it's pretty unrealistic. I think that 300, 500 million is what most VCs that are touching growth equity on this side of things, that's what they're underwriting backwards from. Because keep in mind, it's also much harder to scale something cleanly without a lot of external capital on the consumer side, because you don't have operating leverage, right? If I'm servicing 1,000 customers in SaaS, my margin's just as good as, theoretically, as if I'm servicing 10,000 customers. But that's not the case in consumer. You have COGS that doesn't decrease as linearly. There's not as much operating leverage in the business. So It's more difficult, and that risk needs to be baked in. So you'll see lower valuations.
So when do you actually need help with this stuff?
On the growth equity side, it's kind of weird to use a banker. I think it's fine to use advisors or something like on and off, just depending on the situation. But as far as selling a brand, you probably want to run a banked process if you're over, let's call it like 2 to 3 million in EBITDA.
I agree. I think the smallest they would even take is usually like 20 million in revenue with, 10% margins, kind of a thing.
Yeah, exactly. Cool. I think that's a good place to wrap it. Anything else you want to add?
Oh God, that's good stuff.